Well, we're always looking for the double play. So that's a low valuation business. In other words, one that the investment community is down, sells at a very low multiple of earnings, a low multiple of cash flow, strong balance sheet. But it's out of like we talk about. We like the horrible, the bad trade. Horribly out of favor, and because the news is horrible just to bad, we do really well. So we like to buy in those where the prices are bargains. And then. And then to compound, we want the double play. Like 1983, we bought Waste Management, 9 times earnings, had all kinds of clouds over it. Their earnings more than doubled over the next 6 years. Stock went from 9 times to 40 times, and we made 9 times our money. So you need to get the double, triple play to have the margin of safety. The opposite is a torpedo, a highly valued, popular business everybody loves. It's a magnet for new capital. Comes in and they miss and you torpedo. So the key to compounding is you can't take big hits. I mean, if you go down 50%, you got to go up 100. If you're up 50% in year 1 and you're up 50 in year 2 and you're down 50 in year 3, 8% beats that. So you're always on the lookout of how can I get hurt. So we're just constantly looking at the portfolio to make sure it's compellingly priced, compelling fundamentals. There's a turn up in fundamentals. So we're trying to catch that turn, when the market is down on something, but we see, there's a turn, A good example, a couple of years ago, Weight Watchers, it dropped down to 26. It was 8 times earnings. Market was down, forecasted flat numbers for several years. But they were doing a lot of energetic things as a management team with online initiatives and celebrity endorsements. And sure enough, their earnings went up, sales went up double digit, stock went from 26 to ultimately 80, and so that's why you're just constantly grinding, looking for the turn, because there's always something turning up and then flip side turning down. So you've got to be on those fundamentals. Gets back to it gets back to that rigorous daily research, because you got to catch the turn, but you got to make sure that price is compelling as well. You have a great company, but if it's, Coke was 50 times earnings in 1998 at $80, well, the stock's still in the 70s, and that's been, we sold Waste Management in 1989, and it's lower today than where we sold it in 1989. So you can have a great company, but it doesn't mean you'll make money in the stock.